This question tests the concept of quality of earnings, which refers to the extent to which reported earnings reflect the company's true, sustainable operating performance and are likely to continue in the future. High-quality earnings are generated from normal business operations and are supported by strong cash flows, while low-quality earnings often result from accounting choices or one-time transactions rather than genuine operating success. Analysts evaluate earnings quality because reported net income can be influenced by management discretion in accounting policies and estimates. Examples include accelerating revenue recognition, delaying expense recognition, changing estimates for bad debts or depreciation, and recognizing non-recurring gains. Such practices may increase reported earnings without improving the company's underlying economic performance. Therefore, companies with lower quality earnings often rely more heavily on earnings management than on sustainable operating improvements. A. Hire lower skilled workers or purchase lower quality materials. Incorrect. These actions may reduce costs or product quality, but do not necessarily indicate poor earnings quality or accounting manipulation. B. Manage the recognition of revenues, expenses, gains, and losses. Correct. Lower quality earnings are commonly associated with earnings management, where management uses accounting discretion to shift the timing of revenues, expenses, gains, or losses to achieve desired financial results rather than reflect economic reality. C. Present an operating profit margin lower than the industry average. Incorrect. A low operating margin may indicate weak performance but does not necessarily imply poor earnings quality. D. Rely on a few large customers to generate a large portion of its sales. Incorrect. Customer concentration increases business risk but is not a direct indicator of earnings quality. Correct answer, B. Manage the recognition of revenues, expenses, gains, and losses. Key takeaway: low-quality earnings are often the result of earnings management, where management manipulates the timing of revenues, expenses, gains, and losses to influence reported profits. High-quality earnings, by contrast, faithfully represent the company's sustainable operating performance and cash-generating ability. This question examines the concept of earnings quality, which refers to the extent to which reported earnings faithfully represent a company's sustainable economic performance and can be relied upon to predict future earnings and cash flows. High-quality earnings are generated from normal operating activities, are supported by cash flows, and are based on consistent accounting policies and reasonable estimates. In contrast, low-quality earnings often result from aggressive accounting practices, excessive management judgment, or frequent changes in accounting assumptions that make reported income less reliable. One area that can significantly affect earnings quality is the use of accounting estimates, such as allowance for doubtful accounts, warranty liabilities, depreciation lives and residual values, inventory obsolescence, pension assumptions. Frequent material changes in these estimates can artificially increase or decrease earnings, making financial results less comparable across periods and raising concerns about earnings management. A. Constructed plants in countries with unstable currency. Incorrect. Currency volatility may affect financial performance and exchange gains or losses, but it does not by itself reduce earnings quality. B. Invested long-term in an erratic stock or bond market. Incorrect. Market volatility affects investment returns but is not necessarily evidence of poor earnings quality. C. Materially changed accounting estimates. Correct. Frequent and significant changes in accounting estimates can be used to manage earnings and reduce the reliability and consistency of reported profits, thereby lowering earnings quality. D. Offered significant sales discounts. Incorrect. Sales discounts are normal business strategies and do not inherently indicate poor earnings quality if properly accounted for. Correct answer, C. Materially changed accounting estimates. Key takeaway: earnings quality declines when management frequently makes material changes to accounting estimates, because such changes can alter reported earnings without corresponding changes in underlying economic performance. Consistent accounting estimates improve comparability and enhance the credibility of financial statements. This question tests the relationship between inventory costing methods, inflation, and earnings quality. Earnings quality refers to the extent to which reported earnings faithfully represent a company's true and sustainable economic performance. High-quality earnings are based on accounting methods that provide a realistic matching of revenues and expenses. In an inflationary environment, inventory costs increase over time. Therefore, the inventory costing method chosen affects both cost of goods sold, COGS, and net income. FIFO, first in, first out, assigns older, lower costs to COGS and leaves newer, higher cost inventory on the balance sheet. This generally produces higher profits during inflation but may overstate earnings because current revenues are matched with older costs. LIFO, last in, first out, assigns the most recent, higher costs to COGS, matching current costs with current revenues. This provides a more realistic measure of operating performance and generally produces higher earnings quality during inflation, although reported profits are lower. Average cost smooths cost fluctuations but does not match current costs as effectively as LIFO. Specific identification is appropriate only for unique, identifiable inventory items and is not generally suitable for typical manufacturing inventory. A. Specific identification. Incorrect. This method is used for unique, high-value items and is impractical for most manufacturing inventories. B. First in, first out, FIFO. Incorrect. FIFO may overstate earnings during inflation because older, lower costs are matched against current revenues. C. Last in, first out, LIFO. Correct. LIFO matches current higher costs with current revenues, reducing inflationary profit distortions and producing earnings that better reflect economic reality. D. Average cost. Incorrect. Although acceptable, it does not match current costs to revenues as effectively as LIFO in an inflationary environment. Correct answer, C. Last in, first out, LIFO. Key takeaway: during significant inflation, LIFO generally produces the highest earnings quality because it matches current replacement costs with current revenues, resulting in a more realistic measure of operating performance and avoiding the overstatement of profits that can occur under FIFO.